Imagine if you could quickly tell if a company was a financial fortress or on the verge of bankruptcy. Believe it or not, but you can do just that in a few seconds once you learn how to read a balance sheet. But what is a balance sheet and how does it work? In this video, I'll explain the layout, key terms, and how to analyze it quickly, all in less than 10 minutes. Hi, my name is Brian Feroldi. I'm a financial educator who's been analyzing and investing in businesses for more than 20 years. But let's get started. So, what is a balance sheet? A balance sheet is one of the three major financial statements that shows everything that a company owns and owes to others. It's used by managers, investors, and lenders to get a snapshot of a company's net worth and overall financial health. The balance sheet has three major components: assets, liabilities, and shareholders' equity. The balance sheet is governed by the master accounting equation, which states that assets must always equal liabilities plus shareholders' equity. This equation must always perfectly be in balance, hence the name of the balance sheet. Now, an important detail to know right away about a balance sheet is that it always has a specific day associated with it. Think of this date as if someone took a picture of a company's net worth on paper. That picture is an account of the company's net worth as of that specific date. Now that we have a basic overview of the balance sheet, let's take a closer look at assets. Assets are everything that a company owns that has value. Assets are listed on the balance sheet in order of their liquidity, which simply means how quickly something can be converted into cash. The most liquid assets are on top of the balance sheet, and the least liquid assets are on the bottom. Now, assets can be broken down into two major subcategories: current assets and long-term assets. Current assets are all assets that the company expects to use in less than 1 year. The top line item of the company's assets is cash, which is simply the total cash balance that a company has in its bank account. The next number you'll see is marketable securities, which are all cash-like instruments that could easily be converted into cash in less than a year, such as a CD held at a bank or a bond that matures in less than a year. The next item you'll see is accounts receivable. This is the total amount of outstanding credit sales that customers owe to the company for goods and services they have purchased but haven't yet paid for. Below that comes inventory, which are all of the goods that a company has available for sale. And then the final current asset is called other current assets, which is a catch-all category for current assets that don't fit elsewhere. When added together, all of those numbers equal the company's total current asset values. That brings us to our second major subcategory called long-term assets. These are the assets that a company expects to benefit the company for longer than 1 year. The top item here is called fixed assets, which are all tangible assets that are expected to have a longer than 1 year shelf life. This includes real estate, buildings, and equipment. Please note that the value of these assets are gradually depreciated or written down over time as their value declines due to wear and tear. They are listed on the balance sheet at their current market value. The next item is a tricky one called goodwill. This is the cumulative premiums that a company has paid over its lifetime to make acquisitions. Looking at this number can quickly tell you if a company has been acquisitive in its past or not. After that comes intangible assets, which are all assets that a company owns that have value that can't be physically touched. This could include things like brand names, trademarks, copyrights, and customer lists. The final category is called other long-term assets and includes all other long-term assets that aren't easily classified above. This includes operating lease right-of-use assets, brand value, hedges, and more. When added together, these numbers give us the total long-term assets. Finally, when we add up the total value of current assets plus long-term assets, we get the total amount of assets that a company owns. That brings us to the second major component of the balance sheet, which is liabilities, which are the debts and payments that a company owes to others, such as suppliers, employees, and lenders. Liabilities are listed in the order at which they are expected to be paid off. The liabilities that are due the soonest are at the top, and the liabilities that are due the latest are at the bottom. Just like assets, liabilities can be broken down into two major subcomponents: current liabilities and long-term liabilities. Current liabilities are all the bills that are expected to be paid off in less than 1 year. The first line item of current liabilities is called accounts payable or accrued expenses. These are all of the short-term bills that are owed to others. This could include things like unpaid salaries to employees or any outstanding bills that are owed to suppliers. Below this number are short-term debts. This is a list of all the principal and interest payments that are owed to creditors that are due within the next 12 months. When added together, we get the total amount of current liabilities that are owed to others in the next year. The second major subcategory is called long-term liabilities, which are all of the liabilities that do not need to be paid off for more than a year. The top item in this category is long-term debt, which are all the debts that a company owes to creditors, but the company has more than 1 year to pay them back. You will often see this term called notes or convertible debt or other such names. After that is a catch-all category called other long-term liabilities, which could include things like pension obligations and contracted lease payments. When added together, we get the total value of a company's long-term liabilities that are due in more than 1 year. And when we add up current liabilities and long-term liabilities, we get the company's total liabilities owed to others. That brings us to the final major component of the balance sheet, which is called shareholders' equity. This is the total amount that the company owes to the owners of the business, which are called shareholders. Shareholders' equity has two major subcomponents. The first major subcomponent is the capital that investors put into the business to get it started and fund its operations. And the second is the profit that was internally generated by the company and was kept inside the business. Starting at the top, we see a category called common stock. This is all of the stock that the company sold to outside investors at par value. Below that is a category called additional paid-in capital. This is all of the common stock sold to investors above par value. It's worth noting that additional paid-in capital is normally a much bigger number than common stock, even though these two terms represent largely the same thing. The next major category is called retained earnings, which is the cumulative amount of profit a company has generated over its lifetime that hasn't been paid out as dividends. And the final number you'll see on shareholders' equity is called treasury stock, which is the total amount of stock that a company has repurchased from its investors through stock buybacks. All of the company's equity sources are added together to get the company's total equity, which when we add to the company's liability gives us the total liabilities plus shareholders' equity, and this number always exactly equals the company's total assets. Now, it's important to understand that not all balance sheets will look exactly like this. Each company can choose the categories, names, and layout of its balance sheet when they are producing financial statements. For example, even the name balance sheet isn't used by all companies. Others call it the net worth statement, the statement of financial position, or the financial status report. And each of the terms that you see on the balance sheet may have other synonyms as well. And unfortunately, this is true of all the major financial statements where the terms and categories they're used are not standardized. Now, to make understanding these terms easier, I created a free ebook called Financial Statement School, which explains the layout and key terms you might see on each of the three financial statements. If you're interested in downloading a free copy, simply visit the website that you see on the screen, click the QR code, or click the link in the video description. Now, while all the numbers on a balance sheet are useful, some are actually more important than others. When I'm analyzing a balance sheet, there are 5 key numbers that I always look at first. The first number I pay attention to is cash and marketable securities, which I always add together. This is one of the most important numbers on a balance sheet, and it gives you an idea of the immediate resources that a company can access. The next number I always look at is a company's short and long-term debt, which I always add together. This number will tell me if a company uses debt to fund its operations or not. Now, by simply looking at the company's cash balance and debt levels, you can quickly get a sense for the financial health of a business. As a general rule, companies with lots of cash and no debt are in fantastic financial shape, and companies with not much cash and billions in debt could be in trouble. Now, while cash and debt are by far the most important numbers to look at, there are 3 other numbers that I keep my eyes on. The next number I always look at is goodwill. If this is a big number relative to the company's total assets, it tells me that a company's strategy is to grow by acquiring other businesses, which is a strategy that, generally speaking, I do not like. The next number I look at is retained earnings. This is the cumulative amount of profits a company has generated since it was founded. Now, if this number is positive, it means the business has generated more money for its investors than it's lost over its lifetime, which is a good thing. The final number I paid close attention to is treasury stock. If this number is listed, which it not always is, it indicates that the company has been buying back its own stock, which is generally a positive sign for investors. Now that you know the 5 key numbers to look at, let's take a look at the balance sheet of a real company to see these numbers in action. Here is the balance sheet for Chipotle Mexican Grill as of December 31st, 2023. Please note that you won't see it formatted like this in the company's SEC filings, but I format it this way to make it easier to read. So when I'm analyzing Chipotle's balance sheet quickly, the first thing I look at is the company's total cash balance. Now, in this case, I'm going to add the company's long-term investments to this number. And when I do so, I see that this company has roughly $1.9 billion in total cash and cash equivalents at its disposal. Now, that is a huge number. Now, the second thing I'm going to look for is the company's debt balance. And I'm going to scroll down the company's liabilities looking for names like debt, convertible debt, or notes. Now, I actually don't see that listed anywhere on here, which means that Chipotle's balance sheet has nearly $2 billion in cash and $0 in debt, which makes this company a financial fortress. Great to see. Now, from there, I'm going to key in on the company's goodwill statement. This company has $22 million in goodwill. Now, that might sound like a big number, but when you compare it to the $8 billion in total assets, it's actually a very small figure. That tells me that Chipotle has not grown by acquisition. Instead, it's grown organically, which is a great sign for me as an investor. The next number I'm going to look at is retained earnings, which is $6 billion. That tells me that Chipotle has generated a fabulous amount of profits since it was founded. And the final number here to look at is treasury stock, which is a negative $5 billion number. That tells me that Chipotle has bought back or repurchased nearly $5 billion of stock from its investors since it came public. That means that this company is actively returning capital to shareholders, another positive sign. So with just a few seconds of analysis, you can quickly tell that Chipotle is a financial fortress, which is great to see. Now, like any skill, the best way to master balance sheet analysis is simply to practice. If you can train yourself to focus on these 5 key terms when analyzing a balance sheet, you'll be able to analyze any balance sheet you come across quickly. Well, I hope you enjoyed this video. If so, give it the thumbs up. That really helps us out on YouTube. And if you want to keep learning about accounting, click this video that you see here next.